Good morning. So I'm doing a walk through the woods today, and I'm going to do what Thoreau used to do on his walks through the woods, near Walden Pond, which is talk about income statements. Because, woodland creatures, they loved like the word expense. They love that stuff. They come right up to you, eat out of your hand, as long as you're talking about the P&L. Okay, so if you don't understand the financials of the companies that you want to invest in or have already invested in, you're low key jeopardizing your nest egg. That's not why I'm doing this walk. Remember, every walk to date has been about how you, engineers mostly, but more and more ops partners, pick up both breadth and depth in the businesses that you support. Why? Because you need business depth to be better business contributors, because advancing your career doesn't just require you to be a great coder or some single function operations expert. The path to that next good job, or ultimately the path to landing in the C-suite of any company as the CIO or the CTO or the head of ops, can only happen if you have both breadth and depth in that business. Well, that's not true. You could land a C-level gig, but you won't keep it long. So what does that have to do with understanding the financials of your company? Being able to decipher your company's balance sheet accurately is so foundational, so intimately tied to your credibility as a leader that without that skill, I can confidently say that you'll necessarily be limited in your career, boxed forever into being a waiter, not a chef. Okay, enough preaching. Let's get started. First, a quick view, because holy moly, these rock formations behind me are amazing. All right, a balance sheet is like going to your doctor. Her job is to tell you how you're doing since your last checkup. If you've been eating healthier and exercising, she'll tell you if it's paying off. If you've been sneaking chips and Pepsi, she'll remind you not to. It's how you gauge results, whether you need to diet or gain weight. It's not the only way to figure out where to focus your next set of actions in your business. But if it's missing from the list of your inputs, you're operating at a disadvantage. Okay, some basics. There are 3 sections to most financial statements, even though they're consolidated in the one we're gonna walk through today. And those 3 common sections, each one is tied to the other 2. First, an income statement, also called a P&L, which stands for profit and loss, P&L. It sounds like you're saying P, the letter N, L, but if people would just pronounce the D in and, it would sound like P and L, but everyone just says P&L. Anyway, the income statement, the P&L, shows the company's revenues and expenditures during a particular time period. It shows how the revenues, all the money coming into your business, minus the expenses, all the stuff the company pays for, are magically transformed into the net income or net profit of your company. How cool is that log? Why do they call it net anything? It's because businesses are like giant fishing vessels that pull in profits with giant nets. No. The word net is actually an accounting term. Basically, it means you're adding or subtracting numbers. Profit is non-specialist language. Net profit, net anything, is specialist language adopted from accounting. So an example, and there'll be a ton of them on this walk that use the prefix net. The P&L starts with a number, sales. And after you subtract all expenses, see, a subtraction, it leaves you with net profit. So that was the first of the three sections we quickly covered. We're going to go into depth in all of them. That was the income statement. The second is called the cash flow. It starts where the income statement left off, and it tracks how much cash is generated and used, ending with how much cash is on hand. The third statement is a balance sheet, which starts with how much cash is on hand. See how it flows? 1, 2, 3. The balance sheet starts with cash on hand and subtracts liabilities from assets and ends with shareholders' equity. Beginning, middle, end. Income, some basic math. Cash flow, some basic math. Balance sheet. Done. If only it were that easy. Let's get into the details. Let's go through an example. We're going to use the 10K filing of an actual bank. The 10K is it's the form and format that companies use to publish their annual reports, at least those required by the U.S. Securities and Exchange Commission, the SEC. A 10K should, in theory, give us a comprehensive summary of the company's financial performance. The example I'm going to use on this walk is the last 10K, the last annual report that was published by First Republic Bank, their 2022 annual report. If the name of that bank sounds oddly familiar, it's because they just went belly up, May 1st, last week. They collapsed. The Fed stepped in and sold them to JP Morgan Chase. I'm using them as my example because, in theory, investors use a company's earnings reports to assess its financial position, to figure out if they should invest in the company or not. And as you learn about how to read through and understand earnings reports in general, it's worth reflecting on whether the 10K actually helps investors understand risks. I have my opinions. You should form yours. Quick disclaimer. I have never owned shares in First Republic, but I did work for JP Morgan, an amazing company where you will always be the dumbest person in the room. At least I was. Quick little, how cool is that? They put a little tiny bench that looks at the, New York City in the distance, in the middle of the woods. How cool is that? All right. I'll also include a link in the description below, on YouTube at least, to First Republic's 10K, of which I have one glorious page in my hand for reference. And even though I'm going to provide the link to the 10K, you can find it the same way I found it, right? By Googling company name 10-K. In First Republic's case, it was a 207-page document with another 99 pages of exhibits, bringing it to a robust 306 pages. I mention this because it's an intimidating size. It's kind of meant to be. Like when New York cops say, move on, nothing to see here. Did I bring 306 pages with me on this walk? No. I brought one. Oh, and it has 2 handwritten quotes on the back. So don't be intimidated. The first 37 pages of that monster, of this particular 10K, are a description of what First Republic, as a generic run-of-the-mill bank, does. Banking 101. If you're not familiar with banking, read it. But know that regardless of the company or the industry, it'll be lightly sprinkled with marketing BS. First Republic, for instance, starts its section on business strategy with one of the quotes on the back here. Our core business principles and service-based culture have successfully guided our efforts over the past 37 years. End quote. And what do we know about past performance? Ugh. Pages 38 to 68 in that report, the next 30 pages, is a section called risk factors, which, holy moly, that should be interesting, right? For a bank that just went under. But that's where they explain in the most generic possible way, ideas like credit risk, market risk, default risk, which reads like a cut and paste job from Investopedia, to be honest with you. They go into some detail, but it's mostly a head fake, false detail. Like when talking about credit risk, they write the second little quote. They write, California has had and will continue to have major earthquakes in many areas. Yeah, that's what investors need to fear. Act of God. So, nothing useful until page 73. This one. Their income statement. Let's go through it. And I'll put it like up here. It's the kind of thing you'd want to do. Review this page when the report was just released, within minutes of it having been officially posted. You skip all the banking 101 crap. You jump to the income statement, the earnings statement. A lot of people call that the P&L, which we talked about, short for profit and loss. At the top right, above all the numbers, it says for the year ended December 31st for 2020, 2021, and 2022. So you're seeing 3 years worth of results. That's completely standard. And the fiscal year end for First Republic happens to be the same as the calendar year end. A lot of companies do it that way. There are certainly companies that have a non-end of calendar year, end of fiscal year. And that's usually determined by how busy that they are during, Christmas time. If you're a Walmart or a chain retailer, you'll want to pick a different time of the year to do the hard work of closing out your accounting books. Plus, it's a show. So, you get in front of your investors and do a little dance. You certainly don't want to do that dance on Black Friday, because it would distract you and your investors from all the good fights. Anyway, back to the P&L on page 73. And I'm cutting through a non-walkway because of the mud ahead. What are you looking for when you first look at any income statement? Think sales minus costs equals profit. I know that sounds ridiculously obvious. On this page, the very top line is interest income, which, along with something like 6 lines down, non-interest income, is the bank's equivalent to total revenue. All the money coming in during this period, which to other non-banking companies could be thought of as sales. All money inbound. So that top line is the literal top line that CEOs and CFOs talk about on earnings calls. Top line growth refers to that actual top line. And if that blows your mind, wait until we get to the bottom line. Airplane. Top line growth for this bank is how much that literal top line grew from 2020 to 2021 to 2022, from 3.853 billion to 4.85 billion in 2021 to 5.722 billion in 2022. That's a 14% increase from 2020 to 2021, and 30% increase from 2021 to 2022. The numbers 14% and 30% aren't on the income statement. So you'll need a calculator, but you get the point. That's really impressive top line growth. I should totally invest in this bank, said a lot of angry people 6 months later. Next line down. Repeat the mantra. Sales minus costs, because that's what we're going to look at next, equals profits. So the next line down is a cost. In this case, interest expense. That's good morning. That's any checking account that they pay interest on, any money market savings accounts, again, that they pay their customers, any CDs they've issued. That's about half of their interest expenses. The other half is anything they're paying money on, like money they've borrowed. Federal funds, FHLB advances, which is a funding source for a variety of mortgage products. What else do they pay money on? Senior notes, subordinated notes, which we talked about, subordinated notes or subordinated investors on our private equity walk. If you didn't watch that, don't. It's a terrible walk. So that second line across, the 888, the 271, and the 591, those are some of their expenses, at least tied to their interest income. How do I know that the words interest expense means what I just said? I don't. It's not on page 72. It's a little chart that looks very similar to this one, but on page 83. You can do what I did. If you have an earnings report document open in front of you and you're like, what the hell is interest income? Or what the hell is a provision for credit losses? Do a search on it in the same doc, and there'll be an explanation later in the same document. Okay. See that line that separates the line 2 interest expense from line 3 net interest income? The line under 888, 271, 591. That's basic arithmetic visualization for I am about to subtract. So 5722 minus 888 is, look below it, 4834. The net interest income. Because what does net mean? We did some subtraction. Just like one line down, 4834 minus 107 is 4727. In that case, they're subtracting what they call provision for credit losses from net interest income. What are provision for credit losses? Control F on your keyboard, search for the details in the same doc, and you'll basically get that it's a way of estimating potential losses tied to credit risk. This particular document makes that search result hard to understand because it uses an acronym ACL over and over again that they do define, to be fair, in a glossary of a lot of 3-letter acronyms, but it's hidden. ACL stands for allowances for credit losses. If you don't understand it, Google it until you do. Not just this, everything. ACL in particular is an estimate of the debt that a company is unlikely to recover. It's the lending equivalent of the sweatshirt your friend in high school borrowed. You're never seeing it again. ACL, allowances for credit losses. In plain English, the line called provision for credit losses is saying that, hey, there's been a change in economic conditions, in the macroeconomic outlook. There's been changes, given historical loss rates. And, that sweatshirt we lent out? Sorry, not sorry. It's not that simple. And I just traversed a whole lot of mud. Not that simple because they'll use finance jargon in the rest of the document, fancy words like capital calls, which basically means that someone they borrowed money from is sick of their shit and wants their money back now, capital call, puts little definitions. So, so look at that fourth line, 107 in 22, 59 in 21, 157 in 2020. That's a lot of sweatshirts. First Republic, they had to write all those sweatshirts off. All right, working our way down. You subtract the provisions for credit losses, expensive sweatshirts, from net interest, and voila, line 5, net interest income. After provision for credit losses. It literally says that on the sheet. It's almost like they know we're stupid. The next line down is the second way they make money. Remember line 1, interest income? Well, that and this line, 6, together is all inbound money. Interest income and non-interest income equals all income for these guys. This line is the line that made them an attractive fire sale option to JP Morgan Chase. Their non-interest income are things like their investment management fees, their brokerage and investment fees, because in addition to the boring checking savings account that they offer, First Republic also does wealth management, and it grew by 45% from 21 to 22. So if you're JP or Goldman and you can buy high net worth wealth management clients at fire sale prices, why the hell wouldn't you? They're the most lucrative client segment in the next 20 years. Anyway, that line, line 6, also includes like insurance fees, trust fees, foreign exchange fees, just fees galore. Deposit fees, loan fees. How do I know all this? Because I know how to use the Control F on my keyboard. I searched in the doc, read about it. And you can't have income, line 6, without its related expense. Line 7, non-interest expense. This one's actually easy because it's employee salaries, employee benefit, the company's tech footprint, their real estate occupancy, advertising, marketing, et cetera, et cetera, et cetera. Not every earnings report you'll read will call it non-interest expense, because not every company is like a bank, making most of its money from interest income. But this walk is less about how banks do it or how First Republic used to do it. This walk is really about how you learn to fish, how you can Control F your way to understanding earnings reports and, fitting in the corporate world when people are talking about the earnings release that was just out. And that seemingly gets us to line 8, the bottom line number, literally. And that's net income of 1.665 billion in 22, 1.478 billion in 2021, and 1.064 billion in 2020. Net income. By the way, that's also called profit, or the company's bottom line. That's where the term bottom line comes from, if you haven't guessed by now. Before we move on, though, get your calculator out. Because if you add all the numbers, in this thing that I've hopefully put up, the income numbers in each column or year, and you subtract all of them from the expenses that I've put up that are clearly from this page, doesn't add up to the net income numbers on page 72. You're off by 476 million in 22, 350 million in 21, and 270 million in 20. And that's because they titled the page Selected Financial Data, not all financial data. Those, those missing sums are what First Republic paid in taxes. I'm actually not sure why they wouldn't list taxes on that page, right before the net income line. Maybe it's an accounting practice. I don't know. I have two guesses, probably both wrong. One, they don't expect anyone to tabulate the numbers in their head when looking at a page filled with numbers, because that would be too like Rain Man. Or two, they're ashamed to admit to potential investors how much they pay in taxes. I honestly don't know. If you do, leave some kind of comment and I'll learn something. I just know that it's torture for people who can do the math quickly in their heads. It's like playing every note with the last one on some familiar tune. Dun, da, da, dun, dun, dun. It's torture. Anywho, as you look at your next earnings report, as you zero in on that bottom line, net income, whether you're an investor or an employee, you'll want that number to be higher. Always. Because, nom. More always equals better, apparently. And as obvious as it sounds, it's worth calling out that there are really two levers you can pull to increase that number. One, you can increase the company's total revenue, the money that's coming in, or two, decrease the company's costs, the money that's going out. There it is. In one sentence, you just became a CEO, like in the Shawshank Redemption. Get busy selling or get busy cutting. Okay, how do you do this all relatively quickly? Everyone has their method. Mine, zero in on the company's total revenue. See if it's growing year over year. Preferably compare that, and here's the secret. Compare that in your head to comparable numbers that you've memorized beforehand. Specifically, the numbers of that company's competitors. If you're thinking about, investing in MySpace in 2008, before you even read their 10K, before you find out that they grew by an amazing 80% year over year, well, you should have memorized the appropriate context numbers of their competitor. Facebook, in that case, which grew by, I'm making this up, 500%. Or you do that with numbers from outside that industry that compare MySpace and Facebook to what the hell would compare in 2008 to Facebook sales. Cocaine sales by the Medellin cartel, 1,000,000%. So my point is that you don't start cold with your company's earnings report. You don't just come to that read with some analyst community whisper number in your hand. You always need business context, a competitive context. So, okay, back to how I figure this out when I first look at it. One, you zero in on total revenue and its growth year over year. Next, take a gander at how much net income grew in the last year. If you can see between this year and the year before, so in our case, 21 and 22, First Republic grew its net income somewhere between 12 and 13%. Not on the sheet, 12 to 13%. So you're going to have to use a calculator or, that walnut between your ears to do the math. Compare that to your competitors' numbers. Next, third thing I do, you look at the company's net profit margin. That's net income as a percent of total revenue. In First Republic's case, they use what they call net interest margin. It's shrinking from 2020 to 2021 to 2022. What was it, like 2.72% in 20? 2.6 2.67% in 21 and 2.65% in 2022. Why is it shrinking? Because interest rates are going up in those 3 years. They, First Republic, the company that we're looking at, they're paying more to their customers, to their lenders. So their margins are shrinking. That might or might not be bad. When you compare it to your memorized business context numbers, they probably won't look bad when compared to other banks because all banks are experiencing similar macroeconomic headwinds. But it'll probably look bad if you're comparing to non-banks or at least industries that aren't as critically impacted as banks are to interest rate hikes. For instance, the Medellin cartel. Are they even still around? Whatever. The point. Compare all the numbers you now know how to find in an earnings report to other companies in your industry or in that industry, or even better, more broadly, to see if your company is a better investment than theirs. If you grew up in America as a kid and you loved baseball cards, this is trading cards for businesses. Right here. Has no picture. It should, of like the CEO or the CFO, but it's just a bunch of numbers, the stats on the back of the card. And that was a quick 3-step way to pick up, the right cards. You don't want to trade the wrong cards. To evaluate an earnings report and dazzle your friends at work, right? By doing what everyone hopefully is doing. How do you do a more detailed analysis? You start comparing each of those sets of numbers to each other. So let's say that your revenue numbers look healthy. Year over year, you'll want to compare them to how your expenses increased year over year or decreased, because that gives you a sense of how scalable those businesses are. If every sale, every increase in income comes with some comparable increase in expenses, well, you don't have a scalable or as scalable a business as a company where you can make more and more money without spending the same amount every time to acquire that next client or provide that next client with a similar service. What else? If you look at the bottom line or net income year over year, and you see that it's not just increasing, but increasing at an increasing rate, yay, healthy growth. If you care about details, ratios are your friends. In fact, the middle chunk of this page is a list called selected ratios, which hopefully I've put up, or I will when I get home. Basic EPS, earnings per share. I actually can't believe I didn't cover this already because I'm probably halfway or more through the walk. You calculate EPS by taking a company's net income, subtracting it from dividends that they've paid out, and dividing that amount, that net amount, by the average number of outstanding common shares. EPS is a ratio. Find it where it says net income for 2022, 1.65 billion. Subtract that from 1.58 billion they paid out as dividends, and you get 1.507 billion. And you divide all of that by the number of shares that First Republic has, 181 million, which is not on page 72, but findable in the doc. And bam, you get $8.32 earnings per share, EPS, 1507 divided by 181. You can do the math on a calculator if you don't trust them, but they got it right. Given that all 10Ks love the EPS ratio, as an investor, you can use it as a cross-industry, cross-company measure of your company's performance without knowing or caring if that company is, in banking or they make cookies or video games. Given that EPS drives stock prices, how do you increase it? Two simple levers. Again, and I'm just talking math here this time, not operational methodology. So no management guidance here. You either increase net income or you decrease the number of shares, right? That's why it's pretty commonplace for CEOs to do stock buybacks. They buy back shares of their stock. They retire those shares that they bought back and bam, EPS improves. Okay. What's a diluted EPS? That's the next line on the sheet. It's EPS with a lot of ice. It's diluted. I know, I'm a dad. It's a dad joke. So no, it's actually some calc instead of dividing by 181, the number of outstanding shares, you divide by that plus the outstanding RSUs, restricted stock units, shares that you've already promised to your workers if they stay for another 3 years. It's the dilutive effect, in this case, of the company having 2 million RSUs outstanding. A detail from another page. So the denominator isn't 181 million, it's 183. That's the number of outstanding shares plus, that. So 1507 divided by 183 gets you 8.25. That's rounded up, actually. I'm not going to walk through every ratio up here, but you get the idea. And if you're super interested, each ratio has an Investopedia description in somewhat plain English. This whole section, selected ratios, is the company trying to be helpful to you by doing some of the math for common ratios. They're useful if whoever you're comparing them to also uses the exact same ratios. Not always true, but it is what it is. Once you begin to understand your company's earnings, you'll start to pick up patterns that make sense to you and what you care about. You might latch onto how your bottom line number, your net income line, is growing faster than total revenue or the top line. And you'll figure out that that's great for a mature company. You want to see that in, big dinosaurs of companies. With startups, you'll see a different pattern because at that stage, sales are more important than bottom line profit. Well, at least that's how the market looks at it. The reason being that you're trying to build a customer base to get a foothold in the market. Would it be great if you saw profits growing faster than sales? Hell yeah, that's a scalable business. Or a great management team focused on keeping costs down, increasing economies of scale. Because a focus on efficiencies always increases profits. Well, almost always. What didn't we talk about? That's important, at least, because we didn't talk about a lot. Operating expenses. What First Republic calls non-interest expenses. Other companies call it fixed costs because they're not directly tied to what you're selling. Think like real estate costs or marketing, research and development, administrative costs, like that expensive CEO. It's all overhead. And it all gets a lot of focus when a company wants to create efficiencies. Well, except for the, expensive CEO. His paycheck is, or her paycheck is safe. We also didn't talk about depreciation and amortization, which is kind of important. These are non-cash expenses, which track stuff like stuff that's wearing out over time. Plant equipment depreciates. That's the classic example. Software that you've written depreciates. That's a more recent example. Its value, that software's value, decreases over time. It's an operating expense. When you subtract out operating expenses, you get something called operating income, which some CEOs call EBIT. EBIT is the letter E, the letter B. It's an acronym, EBIT. Stands for earnings before interest and tax. And if that acronym wasn't long enough, I've never know how to pronounce it, EBITDA, earnings before interest, taxes, depreciation, and amortization. Potato. Actually, it's not. Yeah, Warren Buffett and Charlie Munger call EBITDA utter nonsense. And I'm quoting. They urge investors to just ignore it because EBITDA, it's used to deceive investors and discount the importance of depreciation. And they're both way smarter than me. So, they're onto something. Google it as you learn how to navigate your earnings report. Normally, I'd end the walk here in the middle of God only knows where. But there's a reason I picked First Republic. I could just as easily have picked Silicon Valley Bank or any bank that's gone under. Lehman Brothers, where I worked before I didn't work there. The problem that the business community needs to solve is that 10Ks all read like everything's great. They're mostly sales jobs. They lack the metrics that signal real smoke. Or if the signals are there, they're intentionally hidden in, 207 pages or in another 99 pages of exhibits. Those signals might not be in the 10K, but they're there. How else would the Federal Reserve know when to step in? They're not following Twitter. They're not waiting for an actual run on the bank. They're looking at capital calls. They're looking at trends in overnight borrowing, metrics that don't land, in plain view in 10Ks, leaving investors unprotected. And as I said, 10 yards back. That's a problem that the business community needs to solve. Because if it can't, as much as we all hate the burden of regulation, they're there to protect investors, you and me. Okay, I hope you got something out of this. I'll see you at the next earnings call.